Hello everyone, you're welcome back to Library Premium Consult. In today's video, we are going to look at how to solve for some of the questions on Introduction to Business Finance from University of Professional Studies. So if you're new on this channel, hey, what are you waiting for? Smash the subscription button up, okay, and make sure to turn off the notification bell. So once we upload or we go live, you'll be the first person to get it right away. And make sure to smash the like button to give us a thumbs up of this video, so that YouTube can also help push this video to as many students, so that you can also get a benefit to learn on this channel as well. We have done a two-part series of this past question solve. That was MCQ. So after this, have time and go through them, and you'll be good when it comes to business finance and a more advanced financial management. So without wasting my time, let's get started. So you're going to look at question 2, and that is on weighted average cost of capital WACC method. WACC. That's what you're going to look out for in today's video. So let's read the question 2. So after question 2, our next video is going to be on the remaining 10 MCQs are going to solve, and then we also, after that, we also go to question 1 here, and then I think the last question is going to be question 3, more like a theory question that you can also attempt them in that case. So let's read. Question 2. Augustine Co. Limited has the following information in its statement of financial position. So if you have ordinary shares, 50 Ghana pesos, and then the total amount is what? 2,500,000. You see these 3 zeros, so it affects the values or the figures here. So that's ordinary share. Then we have for 13% unsecured bonds. 1 year of unsecured bonds, we are talking about a debenture. A debenture is an unsecured bond, and a bond is a secured debenture. So that one's also 1 million. So let's read. The ordinary shares are currently quoted at 110 Ghana pesos. It means that it's 110 pesos, okay, each. And the bonds are trading at 72 Ghana cedi per 100 nominal block. Remember, when it comes to stocks and then other debt instruments, they are mostly issued in blocks of 100. They are mostly issued in blocks of 100. So when you see a nominal blocks of 100, that's what we are talking about. Actually, they are denominations being divided into 100 blocks of 100 blocks of that instrument, whether a debt instrument or an equity instrument. Is that okay? So that's why you see 72 per 100 nominal nominal blocks. So let's continue. The ordinary dividends of 15 Ghana pesos, that's 0.5 Ghana cedis, had just been paid with expected growth rate of 12%. Corporation tax is for 30%. So recall, calculate the WACC for this entity. So WACC here remain weighted average cost of capital. Weighted average cost of capital. We realize that when it comes to financing of business, okay, business people or an entity has 2 options, okay. The options are whether they are to go for an equity finance or a debt finance. Business have 2 options when it comes to financing its operations with respect to finance. Financing operations with respect to money. Good. It has 2 options, okay. You can either go for what we call an equity finance or a debt finance, or can either go by the combination of the 2. So when they are into the combination of the 2, that is why we establish what we call the WACC. So the WACC method actually is one of the ways that the business used to identify or get to know its overall total cost when it comes to using that individual source to finance its operations. Okay, so the WACC actually is a combination of all the individual sources of finance that the business used to finance its operation. The cost that's associated with all the individual sources of finance that the business used to finance its operation. The cost are going to get, in most of the time, it was expressed in percentage. The value for that finance for all the source represents the weighted average cost of capital. Because for any business to finance its operation, it first of all need to consider the cost that to incur when they use such source of finance. So WACC is one of the key, or cost is one of the key aspects of key feature when it comes to companies using a source of what finance with respect to its operations. So let's take note of that. So here we are asked to calculate the cost of capital. So as I've already indicated, when it comes to finance operations of the business, we have two options. Either you go for an equity finance or a debt finance, or a combination of what the two. I mean, these are the two things that you can look out for when it comes to finance operations of the business. All right, so let's start. We are asked to calculate what the WACC for this entity. Now, so let's list down some parameters here so that we get to know what we are doing. Okay. So in that case, I'm going to solve Augustine co-limited question at this end. So let me come back. Try to take a screenshot of this question. Take screenshots of this question so that once I move on to the next page, you can have a reference question to follow through as I'm about to make parameters down so that you use that one to solve the question. I hope that is clear. So I hope you have taken the screenshot. So let's move on to the next page. So there is a page I'm going to use to solve for the question. So first thing, any question that you encounter when it comes to business question that you encounter, first thing I need to tell us is about the name of the entity. So here is what? Augustine Co-Limited. It's very important that you do that. Augustine Co-Limited. Co-Limited. Align perfectly. Then you are done. So let's start to look at the parameters. So we have what? Ordinary what? Shares. Ordinary shares. So the ordinary shares was valued at, the old price was valued at, per share was valued at 50 Ghana pesos. Okay, so that was the old price. I think when we read, we encounter some other information, so we didn't finish. Let's see. He said the ordinary shares are currently quoted at what? So you see, at first it was 50 Ghana pesos, but now it's currently being sells at towards 110 Ghana peso, meaning 110 pesos. So when it comes to calculation, we know how to utilize these two prices. Okay, so I call the 50 as well the old price. So the 110 Ghana peso is going to be the new price in that case. So let's take note of that. So old price. So here the old price was 50 Ghana peso. So and then realize that the total amount for the ordinary shares when we were using the old price, it was what? It was 2,500,000, or in short, you can read it as 2.5 M Ghana cedis. Okay, so that will shorten everything. So that is that. So after getting that, then we also need to know the number of shares that we issued as an ordinary shares. Number of shares. Number of what? Ordinary shares. So number of shares. So here the business was financing the operation using equity and what? And debt. And the equity was odd shares, and then the debt was a debenture. That's unsecured what? Bond. So number of shares here. Realize that in the question, let's see, we were given the old price and then the total amount that we obtain using the old price per share. So for you to get the number of shares that they issued, it means that you need to consider the total amount they received and divided by what? Per share, so that we get to know the total number of shares that they issued. So this is what I mean. Let's do practical thing here. So here is going to be the total amount, which is what? Which is 2,500,000 divided by the old price was what? 0. So here it's going to 0.50. Is that okay? That's in Ghana cedis. So the cedis will cancel, so we are left with a number. So it's going to be, so per my calculator I had 5 million. So the number of shares that we issue was what? 5 million. 5 million shares, right? So once you are done, cool, you are done. Then let's continue. And there was also an unsecured bond with 8 par value or the nominal value. So when you say a nominal value, you're talking about the initial amount that we actually issue that instrument, whether an equity or a debt worth instrument, in terms of the amount. So the initial price, the initial price in terms of the total amount. So let's talk about unsecured bond. Unsecured bond. Please don't mind the handwriting, okay? Just follow through. That's very important. So realize that the unsecured bond was 1 billion, okay, or in short 1M. Right, so that is, and then we're also having an interest for the unsecured bond to be. So the unsecured bond, the interest attached to it, interest was for 13%. Is that okay? So 13%, that is here. You need to list out all these parameters before you can actually work it out so that you are good to go, okay? And then we are told that the ordinary share is currently quoted at what? 110 Ghana pesos each, and the bond is trading at 72 per 100 nominal, 100 nominal blocks, the denominations. Okay, and then we have ordinary dividend of 15 Ghana pesos has just been paid. So this is what we call a current dividend that has just been paid. An expected growth rate of 12%, corporation tax of 30%. So let's list these also down here. So we have current price of what? Share. Current price of the share. So the current price is what? So here, let me make it straight away, which is what? 1.10 Ghana cedis, and then the bond price is also what? 72 Ghana cedi per 100 nominal blocks. You can see there. Then also we're also having a current dividend. So current dividend was also 0. So let's use in terms of cities. So it's 0.15. Sorry, so let me come out with the cities. 15. Okay, and then so this one, just need to list them fast so that we are good to go. And we're also having the growth rate of for the dividend. So I'll call it growth rate. So growth rate as well, G in most books. Sorry. So growth rate as G. So that one too was what? 12%. And then lastly, we have corporation or tax. Corporation tax, so a small t to be what? 30%. So once you're able to get all these parameters down, the next thing that you need to do is to first of all calculate the individual cost of what? Capital. Calculate the individual cost of what? Capital that you are using to finance the operations of the business. Is that okay? So you're going to start with the ordinary shares. You realize that the ordinary shares, we are given what? Information that the dividend, there's a current dividend of what? 1.1. That's right. And then it is expected to grow at a rate of what? 12%. So when you see a growth rate as an information or as a parameter in a dividend approach model in calculating the cost of capital, then you need to develop two methods, two formulas. If the dividend was to be paid in the future, then there should be a different formula for it. And if it's a current dividend, you also have a different formula for it. So here, let's talk about the cost of the ordinary shares, the cost. So I can say that here, based on the information there, I can say KE to represent what? The cost of what? The ordinary share, which is the equity, is going to be your current dividend, which is what? D with subscript O into bracket 1 plus what? Your growth rate, which is G, all over your current price of the shares. Is that okay? Plus your growth rate, So if it is a current dividend, then this is the formula I'm going to use to compute for the cost of the equity for the ordinary shares. I hope that is clear. So in this case, it's going to be, so we know the current dividend as well. That's the DO. The current dividend, that's the DO as well, 0.15. So it's going to be 0.15 into bracket 1 plus, I know, let me do some wrap-up change here. So 1 plus 0, sorry, yeah, 15 is here. So let's see the growth rate. The growth rate was what, 12%. This one, okay, so 12%, so 0.12. Is that okay? And then divided by, so I know the price of the current price of the dividend, sorry, the current price of the share, sorry, was what, 1.10. This one, okay, this one, I mean, so here too, make it 1.10 plus the growth rate of what, so growth rate of 0.12, 0.1. So in this case, it's going to be 0.15 into bracket 1 plus 0.12 all over 1.10 plus 0.12. So here with my calculator, the cost of capital I had my cost of capital to be equated to, or to be equal to, sorry, as what, 27.27. How did I got that? Remember, this was a recurring value. That's why we indicated it was there. Yeah, at the end of the day, you're going to multiply this whole formula by what, 100%, sorry, 100%. So 100, is that okay? So at the end of the day, I multiply the whole of this expression by what, 100. So you multiply by 100. So when you multiply, you're going to get to 27.2727. I mean, going to be a recurring. So at the end of the day, when you approximate, it should be equal to 27.27 percent. I hope that is clear. So that is the cost of capital for the ordinary shares. So once you're able to do that, then you also continue to work on the current market value of the shares. Current market value for the share. That's why we calculated the number of shares that we have using the old price. So therefore, we can know that if we are aware that we issued 5 million shares, then we know the current price was 1.1. Then we can know the current total market price of what, the shares. I hope that is clear. So in doing so, because of the limited space of my board, let me manage it here so that we have some space for it. So I can say that total market value for the share is going to be, so that one is going to be the total number of shares that we issued there, which is this, so 5 million shares, okay, multiply by the current price of share, which was what, 1.10. I mean, it was 110 Ghana pesos. So to convert to cedis, it becomes 1.10. So at the end of the day, when I multiply, I had 5,500,000. That's what I got for. So let's also see with your calculator too, or better, so you can write what, 5.5 M. I hope that is clear. Then you are good to go. The reason I've done this is that when we are about to, compute for the WACC method, you see the significance of the reason why I calculated for the total market value. I hope that is clear. All right. So that is how we calculate for the total market value for the shares. You consider the number of shares that we issued, okay, multiply by the current price of per share, and then you are good to go. So let's take note of this. So let's move on to talk about the cost of the debt. So this debt was on debenture, right? So to calculate the cost of debt, remember we said that for us to know the actual cost of the debt, it should be the cost of debt after tax. Realize that when it comes to interest on debt, it's a tax deductible expense. So at the end of the day, for us to know the actual or the true cost of debt, it should be the cost of debt after what? Tax. At the end of the day, they're going to subtract the interest on the source, as they're going to take it from our total expense so that we won't tax it. That's what I'm trying to put across. So that's why we call it a tax deductible expenses. But if we're to be shares, it's not a tax deductible expense. So that is why. So when you get to I think question 2b, I'll give more explanations about this source of finance and you get to understand the reason why it is so. So let's relax and then follow through. I hope you're enjoying. So if you are really enjoying this video, make sure to smash the like button, okay? And if you forgot to subscribe, make sure you smash the red subscription button, okay? And then turn the notification bell or subscribe, and then let's go. Here you can learn more. You learn more of accounting and mathematics, and you're good to go. You'll be perfect. Okay, so make sure to subscribe and then like this video. Subscribe and like, and even share with your friends, okay? So that you can reach more audience and get more people to assist them, for them to also to learn and to pass their exams in that case. So let's continue. So let's continue to calculate the cost of the debenture or the unsecured bond. So here is going to be the cost of debt after what? Tax. So here is going straight away going to be the interest. So here you always need to have the formula in mind, okay? So it's going to be the interest into bracket 1 minus the corporation tax, because I said the interest that we paid on debt are tax deductible expenses. So at the end of the day, we need to deduct. So all over the price of the debt, the current price of the debt, okay? So that is the formula for calculating the cost of what? The capital using the unsecured bond. It's a debt instrument. So let's take note of that. So let's see. Okay, let me bring it down. So here I know the interest on the bond was what? The interest was what? 13%. This one, okay? So 13%. Remember, 13% is 13 out of 100. And we also said that bonds are issued in 100 blocks. Denominations are 100 blocks. That's why you see it was 72 per 100 nominal blocks. So here too, you can also say 72 out of 100. So better still, somebody might write in this will say 13 out of 100, okay, into bracket 1 minus, and I know the corporation tax was for 30%, so that one to 30 out of 100, okay. You close the bracket, and I know the price also issued in 100 blocks, so it's going to be 72 out of 100. Remember, the whole of this is going to multiply by 100. All I need to keep in mind here is that when you are done calculating the cost, you express them in percentage, so you multiply by 100, and you are good to go. So let's take note of that. All right, so somebody might write in this way, or others also might write in, because here the 100, the denominator 72 out of 100, the 100 going to cancel the 100 for the 13 at the numerator side. Here you're going to write like something like this: 13 into bracket 1 minus 0.3, okay, all over 72. When you compute for these two, the result is the same. So nevertheless, mind of how you actually present your workings here is going to be the same. So let's see, with my calculator I had the cost of debt here to be 12.6388. So to approximate to 2 decimal places, I had 12.64%. So meaning that here I multiply by 100%, okay? I multiply by 100%, I'm good to go. So this is my cost of debt after tax using the unsecured bond, okay? So now let's also calculate for let's also calculate for the current market value of the unsecured bond. So realize that with the unsecured bond, the current nominal value, the nominal value for the unsecured bond was, what was it? It was this one, unsecured bond was what, 1 million, right? But then currently we are told that the current price for the bond being trading in the market is 72. So its value has fallen, actually it has reduced because we issued 100 nominal plus, and if it is 70, it means that it has fallen. So it's going to reduce the old nominal value for the unsecured bond. So it's going to be, so you say total value and a total market value, sorry. So let me shorten it. Total market value for the unsecured bond is going to be, so it's going to be 1 million, okay, multiplied by the proportion of the price with respect to the 100 nominal plus, okay. At the end of the day, you should be able to get 720,000 Ghana cedis. So that is for the unsecured bond. I hope that is clear. So once you're able to get these values down, so now we know of the cost of the shares, and we know of what that will total market value for the shares. Likewise, that of the debt, 12.64%, then that of what a total market to be what, 720. So here for us to now to calculate the WACC method, so here I can say that here is what, 0.72 M, okay. Likewise this, so let's take it. So now, okay, let me determine the total market value for the two. So let me say TMV, total market value for the two, is going to be your equity plus your debt in terms of their market values, and that's going to be, so here I converted into what, millions. So it's going to be, so let's use that one, 5.5 M plus 0.72 M. I hope that is clear. So in this case, going to be, total is going to be, with my calculator I had 6.22 M, means that 6,220,000 Ghana cedis, okay. So now to calculate our WACC method, that's the weighted average cost of capital, is going to be, so in this case it's going to be the cost of debt, so the cost of equity in proportion to, or relative proportion to, the market value over the total market value for the equity. So it's going to be equity over the total market value for equity and debt. After that, you have our addition sign here, because the number of individual sources of finance will determine the pattern of the WACC formula. Is that okay? So here we're having two, so just two. So then also we also come back to the cost of debt after tax for the unsecured bond, which is the debenture. So also multiply by its proportion that we can derive from the total market value, right? So that one too was what? So here is going to be debt over E plus what, the debt. I hope that is clear. So in this case, I can therefore say that here the cost of equity in terms of percentage was what, 27.27. So it's going to be 27.27%, okay, multiplied by the equity, the total equity, which was what, 5.5 here, 5.5, okay. So 5.5 M plus, so 5.5 M divided by, so divided by the total market value for the two, which is going to be 6.22 M. Is that okay? And plus, so I know the cost of debt after tax for the unsecured bond was for 12.64. So 12.64%, and then multiply by the debt to be 0.72. So divide by 6.22 M. I mean, I don't know, the M is going to cancel the M, so it's going to be all. So at the end of the day, with my calculator, so let me bring every the whole of this. Remember, the whole of this you multiply by what, 100, right? 100. So let's take note of that. 100%. 100. Let me write it all so that I can see. See, I have a limited board space. I'm trying to do everything possible to get it right. So multiply by what? 100. So with my calculator, I had the overall average cost of capital to be 25.58. So when I approximate to 2 decimal place, I had to be 25.58%. So that is my overall cost of capital using the ordinary shares and the unsecured bond. So this is how we calculate for the weighted average cost of capital. This is how we calculate for the weighted average cost of capital. So that's very simple. So all that you need to do is first calculate the individual cost of capital, and then for you to do that, make sure the formula is in your head. Please make sure the formula is in your head. So once you get the formula down, you calculate the individual cost of capital. After that, you also calculate the individual current market value. Is that okay? And then you add the two current market. If it is 2, you add the 2. So depending on the number of individual sources, you add their market values, the current market values together, and then you come and apply your WACC method. So you take the cost of that individual capital, that individual source, multiply by the proportion of that source over the total market value. Then it will be addition. So the cost multiplied by the proportion of that individual source over the total market value, plus then going to be an addition in that order. So as I've defined here, the WACC. So that order is going to be the order of the day, so that you get to understand. So it's very simple. It's very simple. So that is for the WACC method. I hope you have gotten it. If you have gotten it, make sure to give a comment in the comment section. Type in the comment section to make me aware that you have gotten the concept I'm actually building here. So if you have gotten it, smash the like button. Okay, very important. Please, let's like this video more than enough. Okay, I want 1k like for this video alone. Please and please do that. It's very important to me. Please and please do that, and subscribe to it as well. Right? So that is the WACC. So let's move on to, so that is actually question 2a. So let's move on to question 2b. What we are talking about. So they are saying that as a financial consultant of Augustine Co Limited, you are required to enumerate 2 advantages of the following. So you see, debt finance, equity finance, and private placement. It's very simple. When you are talking about debt finance, you are talking about financing a business using a debt instrument. Debt instrument like bonds like bills, notes, and etc. There are many. All right, so these are what we call debt. Those debt financing is a source of raising finance using a debt instrument. That's by issuing a debt instrument to the general public through bonds, bills, and notes. I hope that is clear. So it's a way of financing the business by raising a debt instrument, whether bonds, bills, notes, or any other debt instrument, to finance the operations of the business. So at any time a company or an entity issued a debt instrument, that entity becomes the issuer of that debt instrument. Okay, and the one going to buy that instrument is going to be the one. So we call those people as creditors. At the end of the day, there is a document called indenture. Whether you have heard of this indenture, it spells out the rules and regulations governing the issuing of debt and then the payment. When they issue and then the payment of this debt instrument with respect to the principal sum and then the interest. So we spell out the rules and regulations governing their operation in relation to the debt finance. Is that okay? We call it indenture. So that is the rule of the indenture. It spells out the terms of the arrangement of the debt instrument between the issuer and then the one to be the one who bought that instrument. Is that okay? So you call that those as what? Creditors. So that's the debt finance. But one advantage about debt finance is that because of its nature, it always very easy to, it is less costly to be used to finance the operations of the business. Why? We are saying there is less, one advantage is less costly to be used to finance the operation of the business as compared to equity finance. Why? Because of the nature of it being a tax deductible expense. It being a tax deductible expense. By tax deductible expense, I mean, remember when it comes to taxation, there's what we call taxation of revenue and taxation of expenditure. So if this interest that we pay on debt finance is an expenditure, then when it comes to taxation of expenditure, that interest alone is excluded from our expenditure. So it helps to reduce our tax burden as seen if we were to be included. I hope that is clear. So that's why it makes it a tax deductible expense. One advantage is that it is a tax deductible expenses. For debt finance, a tax deductible expenses. Meaning at the end of the day, when you have to tax our expenditure, that interest alone that we pay to the finance providers is excluded from the tax and therefore reduce our tax burden. I hope that is clear. So one advantage is that it is a tax deductible expense. Two, it is less costly as compared to the equity. Is that okay? And you can even use small amounts, or you can even leverage on small amount of what this debt instrument to create what large to create worth, huge worth when it comes to this. You can use small amount of debt instrument to finance your business to get more worth revenue, more worth of money to in that case create what we call growth rate. Your growth rate of the company is going to increase if you have a perfect strategic management within that entity. I hope that is clear. So that is a debt finance. Actually, it is a tax deductible expense. It is less costly when it comes to using to finance operation of business, and then also with small sum of a debt instrument, you can use it to actually create more worth. I hope that is clear. Then also there's also other advantages I can also talk about. There are many. So but we are limited to two, right? So that is the debt finance. So debt finance. If you have any question, just put in the comment section. I'll answer it to that. So let's come to equity finance. So equity finance is actually the opposite of a debt finance. With equity finance, it is one way of financing the business by raising or issuing shares to the public. So we call the shares whether ordinary shares or preferred shares or preferred stocks, whether a preferred stocks or a common stock. Is that okay? That's what we call equity finance. So equity financing is a way of raising funds through the sale of shares, whether a common stock or a preferred stock, to the general public, so that they will buy it for you to get some money to finance the operations of the business. And one advantage when it comes to using equity financing is that you're able to get capital to finance the operation of the business. So with the amount of money that you receive from the sale of the shares, you can also use that to finance the operation of the business. At the end of the day, you're going to get more profit. So that is one advantage of equity finance. Then also, when it comes to equity finance, shareholders are entitled to future earnings. One advantage is that shareholders are entitled to future earnings as compared to debt finance, where we only pay for the principal sum and the interest at once based on the indenture, what the indenture spells out to the two parties involved. For debt finance, creditors are not entitled to future earnings, but for equity finance, shareholders are entitled to future earnings. So that's one advantage. Another advantage, as I said, is that it also helps the company to use small amount of money to create a large worth. That's another advantage. And then also another advantage for when it comes to equity finance is that because of its nature, it gives room for people to go for the type of the share that you want. Because you have the common stock and you have the preferred stock. The common stock is for what we call the ordinary shares. It has higher risk, and then they receive variable amount, the shareholders. But then when it comes to preferred stock, the dividend is fixed, and then the risk is what? Very low. So because of its nature, it presents to the general public which form of the investment should they make, whether you make in a common stock or in a preferred stock. So it gives them that flexibility. There's flexibility in investment in the equity finance by the general public, whether it's to go for common stock or preferred stock. So that's another advantage when it comes to equity finance. So let's take note of that. Now when it comes to private placement too, so the private placement too, it is also a form of equity finance. Remember, when it comes to equity finance, you have two types of equity finance. So it is either a private placement or an IPO. All right, private placement or initial public offering. So per the name, when it comes to equity finance, how we finance the operation using equity, we have two approaches. Either you go for private placement or initial public offering. So when it comes to private placement, here it is a way that the company used to raise finance, where they where the company sells shares or common stocks to or preferred stocks to some pre-selected individuals. It can be wealthy individuals, it can be banks, government, it can be institutions and others. So that is private placement. Okay, with the private placement, it is where shares are sold to a pre-selected individuals. It can be wealthy individuals, it can be banks, government, or institutional investors, or anything of that. That they sold to them. So per the name private, it is issued to few selected individuals, and then the transaction is being done between them. So it's being done between the entity and then these pre-selected or few individuals that they select to sell these shares to them. But when it comes to initial public offering, actually the shares is being put out to the general public, and then everybody has a chance to subscribe to that shares and then buy one. Then the business will get its money to finance the operation. That is the initial public offering. Is that okay? So the initial public offering, by the name, we are issuing the shares to the general public. By private placement, by the name, is being issued to a few or pre-selected individual shareholders. Individuals, which can be a wealthy individual, banks, governments, institutional investors, and others. To buy the shares, and so that they can use to use the money they generate to finance the operations of the business. Is that okay? So one advantage or some advantage when it comes to private placement here is that because of its nature, it helps to encourage or it helps to reduce competition. Competition in the sense that if it were to be initial public offering, then those who have huge amount, the shares that the company is issuing is far more, when they check everything and see that everything, with respect to the interest going to earn or the dividend going to pay is far more favorable, it encourages those who have huge sums of money to buy more of the shares, and that will hinder those with no money or few money to buy the shares. Is that okay? So in that, it's going to increase competition. So when the competition increase, those with less sum of money, or those with those who are not worthy, but then they want to make investment in this, will not get that opportunity to invest. But then if it will be issued to few selected people, then there is no competition. Competition is reduced, because you have the people that are going to sell the shares to them. So therefore competition is reduced. So that's one advantage when it comes to private placement. Another advantage here is that it helps startup businesses or startup entities or companies to use this form of equity finance to grow or to develop at the utmost. Is that okay? So that is another advantage. It is being used by startups companies to help them to develop, to match up with the giant companies within the industry. So that is one advantage of the private placement. And we have a lot. We have a lot. So you can go Google and then go online, Google it, and then you can get more advantage. So these are just a few things that you need to know when it comes to private placement. So private placement, I've said, is one of the mode of equity finance in which shares are sold to a pre-selected or few individuals who may be wealthy individuals, banks, government, institutional investors, and the likes. So that's what we call what a private placement. So that is that. So an initial problem of, as I've explained, is where shares are sold to the general public. Where shares are sold to the general public for the first time. But once you heard of where shares are sold to the general public, everybody has a chance to what? Buy that shares and to become what? A shareholder within that company. I hope that is clear. But some distinction between the debt finance and equity finance is that when it comes to debt finance, when it comes to ownership and control is retained, because at the end of the day, those people that they buy bonds, bills, and those stuff become creditors, and we only pay their principal and the interest per the indenture, per the agreement between the company and then these creditors. But then when it comes to equity finance, ownership and control is somehow other way being what? Lost, whether full or part. Is that okay? Because at the end of the day, those people who buy the shares become shareholders. They own a part of the company. So ownership and control is some way, other way around, whether lost, whether in full or in part. So that becomes something about when it comes to debt finance and equity finance. But when it comes to debt finance, ownership and control is retained. But at the end of the day, these people are creditors and they cannot claim any ownership within the company. But in debt equity finance, they will claim ownership because they are part of the shareholders of that company. So that is some distinction that we can talk about when it comes to debt finance and then equity finance. And note that these two are used to finance the operations of the business, whether debt finance or equity finance. I hope that is clear. So if you are blessed with this video and you have gotten everything, make sure to smash the like button, subscribe, and share with your friends on campus and everywhere, so that they can also join us and learn on this platform, so that they can become better in their area of studies in relation to math and accounting. So this is where we bring an end to this presentation. If the video was helpful to you, please go ahead to share, like, and subscribe. So I will see you in the next video where we discuss other questions on business finance and other aspects that you will also recommend for me to work on. So I will see you. Thanks for watching. I'm grateful. Thanks for watching. So I'll see you. Bye bye.